Welcome to the weekly review of the markets from Hernandez Retirement Services. This is Agustin Hernandez. This week I will focus on the S&P 500 week ending January 18th, 2019. It has had a strong early year rally. Can it continue? Are we in the beginning of the next big bull rally? I will focus on price and moving average indicators to let us know where we are. Afterwards, I will go over the 10-year U.S. Treasury note. With the recent pullback, is the rally over for this index? Finally, I end the video with what does it mean? Before we begin the charts, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on an examination of past price movements and cannot predict the future. Technical charts reference are subjective. No strategy can ensure success or protect against loss. Investing involves risk, including loss of principal. We start with the S&P 500. In this chart, I will go over the price action beginning on November 1st, 2018 until January 18th, 2019. The price is represented by the solid green red line. Now, the S&P has had a nice run early in the year. It is up close to 6% since it hit a low on Christmas Eve. Last week, I introduced a horizontal line, which showed a new line of resistance. The S&P last week broke above it. That is good news for the index. Just looking at price action, we do see some good news. Now, what will the moving averages tell us? Here we have the chart showing the S&P's 50 and 200-day moving averages. The point here is to see what these trend indicators are telling us. First, we see that the 50-day moving average is below its longer-term moving average. For an uptrending market, the S&P would need to have the quicker moving average, the 50-day, above its long-term 200-day moving average. Also, the slope of the 50-day is still down as of 118. The 200-day looks to have flattened out. Just reading these two moving averages, we see weakness in the S&P. Now let's see what happens when we put the price and the moving averages together. When we put everything together, we do see the short-term technical damage that was done to the S&P. In December, we saw the death cross when the 50-day moving average went below its long-term trend line. A week after, price dropped close to 10%. Since the low, we see a rally and the price of the S&P is above its quicker moving average. Now, since price and the 50-day moving average are below the 200-day, the current rally is considered a counter-trend rally. It is because it is running counter to the downward trend. Rallies in downtrends are not rare. They can be a beginning of a new uptrend, or they can be a bear trap. This can happen when in a bear market, a short-term rally can get people to chase because there may be a sense of the fear of missing out. For now, it was good for the S&P to at least get above the quicker moving average. But there still needs more work to be done before we can confirm a new uptrend rally. Now let's see what an uptrend index looks like. Here we have the 10-year U.S. Treasury note price. The green red line represents the price of the note since November 1st, 2018. And what do we see is a nice uptrend rally since mid-November. It has gone up while the S&P has struggled, but it peaked in early January and it has since pulled back. It has now broken a clean little upward trend line. Pullbacks are normal. The key is whether it can find a bottom soon. Here we see the moving averages of the US Treasury note. And unlike the S&P, here we see a rising 50-day moving average above the long-term 200-day moving average. So just looking at the relationship of these two moving averages, this index looks in a nice uptrend. But to get the true understanding, we need to see price and the moving averages together. Here we put it all together. As we can see, price peaked in early January of 2019. Since then, price has pulled back. But for now, price is still above both the quicker and longer trend averages. The moving averages are in an uptrend position with the 50-day above its slower 200-day. For now, the US Treasury note is just experiencing a normal pullback. For it to mature into a long-term rally, it will have to show strength, and sometimes that means surviving price pullbacks. For now, the US Treasury note is in an early stage of trying to become a long-term rising asset. But the next few weeks will show us if it can mature and grow. What does this mean? The S&P has had a good start to the year, but we have to remember, it is still in a downtrend. This rally is a counter-trend rally. Now, can it eventually lift this index in a new bullish trend? Yes, but for now, it still has a lot of work to do. Patience will be the key. The worry for me is the FOMO trade, the fear of missing out. The S&P is still facing headwinds. Let the process work itself out. Now, the US Treasury note is getting tested. After a 2-month rally, the rally finally got tired. With the S&P gaining strength, this index has stumbled lately. But unlike the S&P, this index is in an uptrend. Yes, it is in the early stages, but it is still up. This is all part of trying to mature into a true bullish rally. Can price hold above its 200-day? Can the 50-day stay above the 200-day? At some point, there will be relief from this pullback. And then we will see if it has the strength to not only stop the bleeding, but break above its previous highs. I would like to thank you for viewing this video and I hope it was helpful. Please subscribe to my channel for future videos.